Hello, accounting enthusiasts. Welcome to Acctvocab, where we simplify accounting terms in just 2 minutes. Ever wondered how accountants predict uncertain financial amounts? Today, let's dive into the world of accounting estimates. What is an accounting estimate? An accounting estimate is a judgment or prediction about a financial figure that cannot be precisely determined at the time. It's based on experience, data, and reasonable assumptions. Here are a few examples. Depreciation, estimating how long an asset, like a car or machine, will last. Bad debts, predicting how much money might not be collected from customers. Warranty costs, estimating the expense of future product repairs or replacements. Why are they important? Accounting estimates ensure that financial statements are accurate and reflect the most realistic financial situation. While they involve some uncertainty, they are crucial for informed decision-making. How are estimates reviewed? Over time, estimates are reviewed and adjusted if needed. For instance, if you overestimated warranty costs, you'd revise that in future reports. So, the next time you see an estimate in accounting, remember, it's a well-informed guess to keep financial records meaningful and up-to-date. Found this helpful? Don't forget to like, subscribe to Acctvocab, and share this video with others looking to learn accounting the easy way.